Hello and welcome to today's daily education here at Forex.Academy. I am, of course, your host, Robert Blackwell, and have the pleasure to walk you through today's daily educational video. Now, before we do progress, please do discuss and consult the following disclaimer. There is risk inherent when trading the financial markets. So always take the risks involved into account. And the content of today's particular daily education video will be discussing risk-reward ratios. So let's define first and foremost what is a risk-reward ratio. Well, risk and return are inextricably linked. Okay, so there is of course a relationship between the amount of risk you take on a trade to the return, the possible return available on that trade. The possibility of potential return rises with an increase in risk and vice versa. Okay. One way to manage the risks involved in trading is to acknowledge a positive risk-reward ratio. And I would hope that many traders will obviously comply with trying to run a positive risk-reward ratio. So we'll define what that is. Risk acceptance levels vary from person to person, but you should never trade with an uncomfortable level of risk. And that's very important to notice and to comment on as a financial trader, guys. You know, some of us are more risk averse. Some of us don't like to take big risks in the market. Some of us like to remain objective by only taking perhaps 1% risk on each and every single trade we take, whilst others might take 5% risk on one trade or 2% risk on other trades. So that's absolutely fine. It's as long as it's in a structured framework of risk management and obviously you're comfortable with the level of risk you're taking on. Risk acceptance is both a financial and mental exercise. Of course, that is most certainly the case. So, you know, we do need to know the monetary exposure of the trade in particular. And of course, we need to have that level of satisfaction that we've taken on, a comfortable level of risk as a mental choice. Traders can profit over the long term, even with a 40 to 60% win ratio if they adapt a positive risk reward ratio, of course. So let's say, for example, you're choosing to trade, you're looking for perhaps $70 or €70 winners as opposed to perhaps a €20 stop loss. That is, of course, a very positive risk reward ratio. So if you're able to take at least 2 of those winning trades out of 5 trades, well, you're going to be profitable over the long run. And that's effectively running a positive risk reward ratio with the ability of obviously allowing yourself to take quite a few losers. So let's define these risk-reward ratios in terms of discussing both options, of course. A positive risk-reward ratio is when you consistently make more on winning trades than when you lose, of course. And I'll give you an example here, making €100 every time you win on a trade and losing €50 every time you lose on a trade. Okay, so of course, we're effectively running a positive 2-to-1 risk-reward ratio. Effectively, we could only have 4 winners out of 10 trades. Of course, we would lose 300 and we'd make 400. So we'd be positive there overall. Okay, so that's the aim of the game. Of course, perhaps you'd like to extend your risk-reward ratio to more than 2-to-1, perhaps 3-to-1, and you can aim for higher profit targets there. Alternatively, you could look to run a negative risk-reward ratio. Some traders obviously do this in the Forex markets, considering how volatile they are. And of course, the more volatile the market, the more likely you're likely to get your trade triggered off with running a negative risk-reward ratio. In essence, it's when you consistently make less on a trade when you win than when you lose, of course. So in terms of just following the markets and looking to trade with trends, of course, you're not necessarily allowing yourself the opportunity to make as much money as possible in the market. So that is, of course, one huge disadvantage to trading with a negative risk-reward ratio. And again, as an example, making €50 every time you win on a trade and losing €100 every time you lose, you're operating here effectively a negative risk-reward ratio of 2-to-1. Okay. Now, the impact itself can be quite damaging psychologically, because if you choose this 2-to-1 risk-reward ratio, for example, and you're going to perhaps set up a trading account and get involved trading the markets, perhaps with €1,000, and you decide, I would argue this was too much risk to take on one particular trade of that account size. However, for illustration purposes, we'll describe allowing yourself to take a €100 losers, 10% over a €1,000 account on one trade. Effectively, if we have 3 losing trades consecutively, okay, we're effectively losing €300 on a €1,000 account. So that's quite a substantial amount. It's going to have a damaging psychological effect on our trading. Okay, so one point I'd like to note: it is possible to make money from both approaches. However, be mindful, be careful. All high percentage win ratio strategies normally operate negative risk reward ratios. Just be mindful of the potential consequences there, okay? And it is going to be indicative to the style of trading, to the market you trade, and of course, to the monetary exposure on a particular trade, okay? Positive risk reward ratio, of course, let's finish with the positive risk reward ratio. We'll define it again: the potential aim to make more from one individual profitable trade than to risk losing on one trade. If our upside target is $150 again, and our stop loss or financial exposure is $50, of course we are running an effective positive risk reward ratio. We have a positive risk ratio if we make more on a winning trade than we lose on this failed trade. So just to reiterate, we're trying to outgrow the markets. We're trying to allow ourselves the performance to make more on the winning trades than to lose on the trades that we effectively fail on. This clearly means we can be less accurate and still make money once we stick to this type of risk reward ratio. And of course, it's quite difficult to develop a level of consistent accuracy in the markets, guys, because it's a very difficult pursuit to be structurally hitting 70% or 80% win hit ratio. That's very difficult if you're a scalper, if you're a day trader, or technical analyst, fundamental trader or long-term trader. So of course, guys, you want to develop something where you're going to be able to find a balance between your accuracy and your risk reward ratio. So that concludes our daily education for today. I'm Robert Blackwell here at Forex.Academy. Thank you very much for joining us. We'll see you next time. Bye for now.